Okay, well, welcome to Vital Talk Veterans Day, November 11th, 2021. Can you believe it? A big shout out to all of our active military and their families and supporters out there, and our military families who've retired or served this country in years past. We do salute you. And Vital Talks is here today as a series presented by California Staffing Professionals, CSP. Part of our VITAL acronym is V for Vital, Visionary Thinkers, I for Integrity, T for Training, A for Advocacy, and L for Leadership. And today, as part of that leadership, is we have top-notch legal and financial experts who are industry partners who are going to help us navigate key issues. And this session is live and it is recorded. And you want to stay tuned. You want to stay tuned to the end because there's some special goodies that are generously being provided by our presenters. We have Citrin, Cooperman, accounting and financial experts here today, and the very popular Becker Law. And we're really blessed to have you gentlemen. And I know you wanted to introduce yourselves. So I'm going to change slides and let you get started.
Well, thank you, Michelle. It's always a pleasure to be on Vital Talks and to get the opportunity to speak to our friends at CSP. And a little different presentation today because usually when we speak on CSP, we're focused in on a specific emerging issue in the industry and trying to shed some light on that for all the great folks in CSP. Today we're going to jump around a little bit. We do have a theme, and that is a theme of common mistakes that we see as professionals that serve this industry on a day in and day out basis. And we're going to look at common mistakes kind of from two different perspectives. First, from the accounting perspective, and we're lucky enough, and I'm lucky enough to be joined by BJ Hoffman and Michael Zyborowicz of Citrin Cooperman, and they're going to share insight that they have from working every day on the financial situation of staffing industry clients. And then on the legal end, I'm joined by my partner, Chris Leddy. Chris is a former in-house counsel at a tech staffing firm. And Chris is going to speak about some of the common mistakes that he sees our staffing industry clients make. So should be a great topic. I'm sure there's going to be some things that everybody learns, and we will jump around. We do encourage folks, though. We love being challenged, especially CSP is always such an active audience. We love being challenged and ask questions as we go. So if you have a question as we're moving forward, please feel free to put it in the chat, and we'll try and answer it as we go. Chris, I think I'll start with you. And I know this has been a big topic all year long. It impacts a number of different areas of our industry, and in particular, it impacts tech and healthcare and construction and a couple other areas. Truck drivers who, we have staffing clients who place truck drivers, but a lot of different areas in the industry, and that is independent contractors. And obviously, California, as usual, leads the way in law and new law governing who is and who is not an independent contractor. But can you talk briefly about what the current status or lay of the land is with respect to the independent contractor classification tests?
Sure, Mark. Thank you. And thank you for having me here. So obviously, like you said, Marty, independent contractors test, especially with everything that's been going on in California, has really become a nationwide issue, and it's really pushed out into other states. So, I would say California lit the fire. It's pushing out across the nation and even at the federal level. But real quick, different states do have different standards, different tests. depends on the type of claim, for instance, whether it's a wage claim, unemployment claim, or a workers' comp claim. But each test is generally a form of three, right? You have the IRS test, economic realities test, and the ABC test. All these tests are very similar in that they're looking for things like control, whether the work is being performed outside the normal course of the employees who are performing work for you, and opportunity for profit and loss for the independent contractor. The difference between the IRS test and the economic realities test versus the ABC test is the economic realities test and the economic realities test and the IRS test are factor-based, meaning you're going to look at IRS test has 20 factors, right? Economic realities test has 7. Even if you fail a majority of those, if you pass what the court or the auditor deems to be the controlling one, you still pass the test. Whereas with the ABC test, you have to hit the 3 prongs. You have to hit A, which is control, B, the work is performed outside the normal course of the business, and you have to be in an established industry, trade, occupation. So if you fail any one of those 3 parts, you automatically fail a test, even though you might have passed the other 2. So that's the big difference, right? Also, you have to keep in mind the burden is on the employer to prove that these people are in fact ICs, because everybody's automatically assumed to be employees. So employers have a big burden there to get over. Again, like we mentioned at the beginning, definitely want to become familiar with the ABC test, even in other states at the national level. If you're familiar with California's, then you're in good shape, because the federal government is looking to pass it at the federal level. It's in the PRO Act, still pending before the Senate. So if it does eventually pass, it will become a nationwide test, and the other states will have to follow it as well.
Let's talk about that for a second, Chris. Everybody at CSP is probably, in some ways, had AB5 beat into their head probably way too much. So we'll talk a little bit about AB5, but I think what's important to make sure that everybody on the program understands is what exactly the federal government is thinking about doing, and how similar or dissimilar that might be to AB5, which probably everybody on this program is already aware of. So maybe you can talk them through that and what the federal government is doing.
The federal government right now, it's in backlog. It's been underneath, or it's been under consideration, I think, for 2-3 months now. I don't see going anywhere anytime soon. However, the new year could bring new changes. So that's really at the federal level. States across the country too have invested millions of dollars into misclassifications, not just California. From coast to coast, they're trying to crack down on independent contractors. You've seen, I'm sure everybody's seen lawsuits out there, articles about gig workers, truck drivers, and they're leading the fight. The staffing industry is very actively lobbying too for the PRO Act not to go into place. So I'm not sure it goes into place, but it is out there.
And what is the difference, if it does go into place, between AB5 and what's proposed at the federal level? Is there a difference, or is it the same test?
I believe it's very, very similar. Very similar. They're modeling it after California's ABC test, which California's ABC test. ABC test is not uncommon, right? A lot of states do have it. I believe right next to California, Utah has it. New Jersey obviously has it. Parts of the Northeast have it. It's just California's is kind of the ABC test on steroids. I guess, but some of the good things that California does is that their ABC test does have exemptions to it, whereas other ABC tests do not. So it's good and bad, right? It's not the best test, but it's not the worst either, because of those exemptions.
Well, those exemptions are important, and probably many people know about them, but why don't you remind folks about what those exemptions are?
Yeah, so there are some exemptions to the ABC test, such as for physicians and psychologists providing services to or by a healthcare entity. So if you're in staffing, that probably wouldn't work for you. But even if you do pass that, you're still subject to the Borosko test, which is a multi-factor test, so it's not as stringent as the ABC test, but you're still a significant hurdle to get over. A lot of staffing owners have asked about the business-to-business exemption and then the referral agency exemption under AB5. Unfortunately, neither of these typically apply either. For the business-to-business exemption to apply, the main issue is the requirement that the contractor must be providing services directly to the staffing firm and not to customers of the staffing firm. All right, so that wouldn't work here. Also, the contractor must actually contract with the other business and maintain clientele without restrictions, meaning there can't be restrictive covenants. For the referral agency exemption, the contractor would have to provide services to the client under the contractor's name, not under the staffing firm's name. Also, there can't be any restrictions placed on contractors to provide service to any clients. So again, let's say even assuming you fell under one of these exemptions, the Borello test still has to be passed. And again, while we said it was a lower standard, it's still a hurdle that you're going to have to cross, and the burden is on you to meet that test.
Thanks, Chris. Talk about some of the risks, because I know we're having constant conversations especially with our tech staffing firm clients, our healthcare staffing firm clients. California staffing firms, because of AB5, have migrated a little bit faster, but we still have some conversations with our California staffing firms about the risks of having independent contractors in your contingent workforce, and the pros and cons of that.
Yeah, for sure. So if you fail a test and employees are ICs are reclassified as employees, you're going to have to pay back payroll taxes. There's also penalties and fines associated with it, right? For instance, if the IRS determines that you misclassified someone, you're going to have to pay a $50 fine for each W-2 that you failed to file. You're going to have to pay a penalty of 1.5% of the wages that were earned, plus 40% of the FICA taxes as a penalty, and 100% of the matching FICA taxes that you should have been paid, right? So depending on how many ICs you had that are now converted to employees, that could be very costly. And that's just at the federal level. You then have to look at the state level too. And state level penalties, like for example, in California, they can assess penalties of $5,000 to $25,000 per violation. Work orders, there could also be a stop work order issued. You could have your license suspended or revoked. So again, it could be devastating to employers. I think the biggest piece though is wage and hours, right? Wage and hour suits, especially class action suits, which are very prevalent in California. That would typically come about when the IC is reclassified as an employee. That IC had worked 50 hours a week, wasn't being paid overtime, was just being paid straight time. Now they have claims for overtime damages, which are either double or triple normal damages. Plus, there's an attorney's fees aspect to it, so there's fee shifting, which is going to be at least a few $100,000 to try the case, and plus interest. So that's really where it lies, and those lawsuits are typically millions of dollars. And so for these reasons, if you're looking to sell, get rid of all your ICs if you can. Get them to W-2s, because it's going to increase your risk profile, meaning it's going to lower your multiple. It could cost you earnouts, bigger indemnifications than you otherwise have to provide. There could be holdbacks as well. So all things to consider, especially if you're going to market or you plan on going to market.
Let's talk about folks who are using independent contractors, and I guess we can talk about two types. There's independent contractors who are just individuals and being 1099, and then there's what I would call the corp to corp contractors. Talk about whether corp to corp mitigates the risks of these independent contractor classifications, and if so, what folks can do to facilitate those corp to corp relationships and gaining as much protection as they can.
Yeah, so maybe, right? So if they're a single member entity and that person, that corporation, you're contracting with the S corp, is a single owner. That owner is doing all the work. Any auditor, any agency can look through that relationship and say, no, they were doing it just to avoid payroll taxes on both sides. So it's no foolproof way. However, if you are going to contract with a C2C, you want to make sure that they are, in fact, a business entity, right? You want to get their certificates of good standing, their certificates of formation. You want to have proof of that they have employees, right? So get a redacted version of their 941 with just box 1 showing how many employees they have. You want to make sure that they're not just relying on you for income. They should be servicing other clients. If you can somehow get them to show you proof that they are servicing other clients, that's great. The big one is, does that contractor or C2C have a website, a company phone line, email address, physical business location? That is the first thing an auditor is going to do. Is they're going to Google this company. If they can't find this company, it's going to set off red flags, right? So you definitely want to make sure that they have all those as well. You also want to make sure that there's a paid when paid clause. There has to be an opportunity for profit and loss here. Typically, the way C2C agreements, even IC agreements, are written is, I'm going to pay you hourly, right? And it doesn't mention whether you've received money from your client in order to pay them. I think putting that in there, not saying that you can't advance them money, but it should be advanced that they have to pay back if you never received the money from your client. But your obligation should only be to pay them when you are paid. There shouldn't be rights of termination either. Rights of termination, there shouldn't be a right of termination for convenience, maybe on your side, but not on their side. You're hiring them for a specific project. When you have that type of clause in there, it looks more like an employee-employer relationship. You definitely want to make sure they have insurance. You want to be named as additional insured with their insurance being primary, yours non-contributory. Absolutely 100% important. You want to have indemnifications as well, protecting you from their breaches. And if they are reclassified as an employee, or any of their employees are reclassified as one of your employees, or found to be joint employment, they're going to indemnify you for any fines, penalties, or liabilities associated with that. And just on a strict IC basis, if you have W-2 workers performing the same or similar functions, you should not enter into an IC agreement with that person, right? Because the auditor is going to say, well, you have this W-2 doing this job, the IC is doing the same job. What's going on with that? I think that's a very important piece too.
Thanks, Chris. All right, I'd like to bring in BJ for a little bit. We'll get back to you, Chris. Especially, I want to talk to you about COVID wage and hour issues, and of course the latest OSHA proclamation with respect to COVID. But right now, BJ, I'd like to talk to you about, I know, what is a minefield for many staffing firms, because so many staffing firms work in multiple states and multiple locations, and that is state and local taxes. My first question is, do you consider this the number one area where you see your staffing firm clients making mistakes?
Thanks, Marty. Thanks for having us. Great to be with you. CSP, always nice to be presenting. Marty, my partner joining me today, who's the co-leader of the staffing practice for Citrin, Cooperman, Mike Zyborowicz, we work with hundreds of staffing clients, and yeah, you're probably right, Marty. Number one on the list of problem areas historically, even before COVID, has been state and local tax issues. Before COVID, we all know that, and have all seen, staffing firms get tripped up by state and local compliance issues. As you all know, you have contractors that very often are working all over creation, and as they cross jurisdictional boundaries and state lines, with that comes additional compliance, registrations with secretaries of state, payroll taxes, income tax filings, and that's always been a problem. It's a headache to deal with. There's a morass of different rules. Yeah.
Yeah, let's dig into it a little bit, because I know that it was complicated before COVID happened, and I know that my knowledge of it, and I see it in the M&A context when I'm working on M&A deals, but my knowledge of it is it got even more complicated after COVID. So let's break it down, maybe, if you can, BJ. Let's start with, like, pre-COVID, what the rules and the tests for determining when you had to file in a particular jurisdiction. And then once you talk about that, then we can talk about how COVID's changed that.
Yeah, so a couple of things. Historically, pre-COVID, a lot of staffing firms, again, have contractors working in other states. So you may be headquartered in California, but you may have a recruiting office in Arizona, contract workers working all over the country. It's always been the case that if that is your fact pattern, you not only need to be registered with California, of course, but you've got to be registered for payroll taxes and income taxes and with the Secretary of State in these other states. Once you have a physical presence, what we call tax nexus in another state, it sort of draws you in to that morass of compliance. And that's always been the case. So if you've got a contractor working in another state, you're in that state. By law, you need to be filing, or theoretically need to be filing. And certainly if you have bricks and mortar, if you have an office in a state, that's going to drag you in as well. And again, that's always been the case. But Marty, along comes COVID. And though we've always had this issue with the contractors working all over the place, during COVID, everybody figures out that your internal workforce can work anywhere. Everyone wants to work from home. So you're a California staffing firm, and all of a sudden your sales team and your recruiters are working from their homes or second homes in, lo and behold, Florida, Texas, these low or no tax states. And, that for a short period of time was okay. Many states during COVID had temporary regulations in place saying, if you've got people working from home temporarily because of COVID, don't worry about it. You're not obligated to register. But a lot of those temporary regulations have fallen away at this point. So if you still have people working, your internal staff working from Texas, Florida, and all the other states that are out there, you're now going to be dragged in to those states, which is, it only creates more of a headache. The way we look at it is you've got this triangle that you need to consider. Every staffing firm needs to consider, where are you headquartered, where are your customers, and where are your employees physically working. And that triangle is just a complicated mess of administration. We often hear from our clients, look, I've got one contractor working for a month in Michigan. Do I really need to register there? Do I really need to pay taxes there? And look, we understand the headache, and we can never advise you to, flout the rules. But we understand that you might want to say, I can live with that risk. The risk of having a short-term employee in a state and not registering. I understand. You don't want to register. You don't want to go through the compliance. But you need to know what the exposure is. You need to know what the risk is. And frankly, some of this stuff comes home to roost if you're a serial non-complier and you are looking to sell in this supercharged M&A environment that we're in. A lot of this stuff is going to come home to roost during due diligence, and you're going to be offered perhaps less in terms of a buyout, or there's going to be more placed into an escrow. And Marty, you seeing that on the M&A side from a state compliance perspective?
I'm in a deal right now. Person does business in the West Coast and is registered and has paid taxes in 5 of the 6 states that they do business in. One of the states that they did business in, they had the rationale and didn't believe they were going to do much business in there a few years ago. So they took a risk, which, as business owners, that's your decision, right? That's your prerogative to decide what risk you're going to take and not take. So they decided to take a risk and not get authority to do business in this one state and not pay taxes. And now it's 2 or 3 years later, and they've done, a modicum of business, not as much as they do in the other states, and the buyer is concerned about it. And we're now negotiating what the ramifications of that are going to be. So yes, see it all the time in the M&A. And you know what? And I've just dealt with it with direct hire, and these terms make my head spin. BJ, maybe you can talk about how complicated it's got with respect to permanent placements and how you source and recognize revenue, because that's gotten really confusing in my mind.
Yeah, it's a big change. It used to be, well, first of all, direct hire in and of itself has become much more prevalent. It's always been prevalent, but with this cap on contract revenues, because nobody can find workers, at the same time in this post-COVID environment, people are bouncing around between jobs, executives. The direct hire piece, the revenue stream, has really picked up steam. Direct hire, from a tax perspective, it used to be, generally the revenue that you collected from placing somebody was sourced to where your sales team was sitting in their chair. So, you're in California, you've got your sales team in California, place somebody in Pennsylvania, earn a nice big fee. That was California revenue because the work, what we call the cost of performance of that service, was done from a chair in California. Today, many states have moved to a market-based sourcing of revenues for income tax purposes. So in that fact pattern I just shared with you, your sales team is sitting in at headquarters in California, and you get a placement in Pennsylvania or a few placements in Pennsylvania, and you get $100,000 in fees a year, even if you have no employees setting foot in Pennsylvania, because the market, you're selling into the Pennsylvania market. Pennsylvania may very well take the approach that you owe taxes and you should be registered with Pennsylvania for that revenue stream. So again, it's another change in the laws that has really made things much more difficult and complicated from a compliance perspective in the multi-state venue. If you're in California staffing firm, and you're only filing taxes in California, maybe that's right, but I'll bet you that technically you're probably not filing somewhere you're supposed to, and you really should at least know what that exposure is. You should know the rules so that you can make an informed decision. So that's sort of our thought process, and yeah, you're right, Marty. We're seeing that a lot more on the direct hire piece today.
Talk a little bit about, just advice. Look, this is a business decision, what risk you take on and what risk you don't take on by either not getting authority to do business in a state or not paying taxes in a state. Talk about just the way that you try to help your clients sort through that risk and make those decisions.
Yeah, so generally we'll take our existing clients and potential clients, of course. We'll brainstorm and we'll say, all right, share with us where your employees, your internal employees, are working. Share with us where your contractors are working, and tell us on the perm placement side, where are you earning your fees? Where are those customers? Where are the placements physically landing? And we'll compare that revenue stream, perhaps for the most recent 12 months. Compare that to where you are filing. And then, we'll have a meaningful discussion about, well, theoretically, you should be filing in Nebraska, but it's not all that material, so we would understand why you might take a pass on that. But boy, you've got a lot of work in New York. You got a lot of perm placement in New York, and New York's pretty sophisticated. You may want to start filing there and avoiding or at least mitigating some of the risk that manifests itself by noncompliance. So that's a fairly typical engagement that we work with our clients on, for sure.
Thanks, BJ. Chris, I want to circle back to you. COVID has changed the way folks are operating, and it's changed a number of the ways folks are operating because of different compliance issues that are relating to COVID. Let's start with the latest from OSHA. And can you talk about? I understand that OSHA's latest proclamation has been stayed, but you can talk about what OSHA just came down with and how it would impact folks.
Yeah, for sure. So, like you said, it has been stayed, but we are advising clients, to get ready for it because due dates for the policies and getting them out, disseminated, gathering information is December 6th, so it's right around the corner. So if the stay is lifted at any point, you don't want to be behind the 8 ball scrambling to get it done. So what the OSHA rule requires is all covered employers. So covered employer means an employer with 100 or more employees corporate-wide, right? It doesn't matter where they are, what they're doing. If they're in different states, different divisions, they're your employees, whether they're full or part-time, right? So it's not like PPP where you got to count somebody as half an employee for part-time. These people are counted as one towards the 100. So what you have to do, you have to develop and implement and enforce a mandatory COVID-19 vaccination policy. However, there is an exception where you can instead establish, implement, and enforce a weekly testing policy for those who are not vaccinated, where they also have to wear a mask at the workplace. Additionally, employers have to provide all employees the following in a language. So if they only speak Spanish, it has to be in Spanish. And at a literacy level, the employees are going to understand. And that is, number one, information about the requirements of the rule and workplace policies and procedures established to implement that rule. The CDC document, key things to know about COVID-19 vaccines. Number three, information about protections against retaliation and discrimination. And number four, information about laws that provide criminal penalties for knowingly supplying false statements or documentation. Also, to comply with the rule, the ETS does state that you have to require employees to report any COVID-19 positive test or any diagnosis. You have to immediately remove that employee from the workplace, regardless of whether they're vaccinated or not, and they have to stay removed until they meet the criteria to return to work. It's also important to note that all employees who are not vaccinated must wear masks when they're indoors or when they're occupying a vehicle with another person for work purposes. And you can't prevent a vaccinated person from wearing a mask if it's no which.
Thanks, Chris. Let's start with the threshold question. How do companies determine if they meet that 100 employee threshold?
Yeah, so it's easier, but doesn't make a lot of sense. So what you're going to look at 100 employees as of November 5th. If you had 100 employees as of November 5th, you're automatically required to comply with the standard throughout the duration of the standard. So until they pull it back. So that means you have 100 employees November 5th. You now drop down to 50 employees next month, right? Maybe you're a seasonal employer. It doesn't matter. You're already under the standard. For the duration of the standard, you have to comply. Same thing, right? If you were under the standard as of November 5th, you've now increased. Maybe you're at 90, now you're at 103. You then drop back down to 90. Once you pass that threshold, you're automatically enrolled in that standard. So you have to comply, again, for the duration of the standard. For staffing agencies, you're just counting your employees, but you're counting both your external and internal employees. You're not counting, obviously, any of your host employers' people, nor are they counting yours. I just want to note, though, that the testing standards do not apply to cover workers who don't report to the workplace, where individuals such as customers or coworkers are present or while they're working from home, or in circumstances where they're working strictly outside.
Chris, there's always confusion. As you know, many staffing firms opt to put their contingent workforce not on their own payroll, but on an employer of record or PEO's payroll. Who counts the employees in those circumstances? Has there been any guidance with respect to that?
I have not seen any guidance with respect to that. I think it's probably how that contract was written. Yeah, I think you're probably going to have joint liability, but one of you is going to have to take the responsibility for that. I would assume that it's probably going to be the employer of record because they are your common law employer at that point. And then, so then they're going to have to institute the testing requirement there.
That makes sense. Let's talk about the testing requirement. What is the requirement and what is the standard?
Yep. So the rules state that anybody who's not fully vaccinated has to be tested for COVID-19 at least weekly if they go to the workplace at least once a week, or within 7 days before returning to the workplace. So if they're away from the workplace for a week or longer, they have to get tested 7 days prior to returning. So that means you or I, we couldn't just run into the office one day if we had to make copies. We would have to get a test, wait 7 days, go make copies after 7 days. It doesn't make a whole lot of sense, but it is what it is. The rule also does not require employers to pay for the costs associated with testing. However, employer payment for testing may be required by their laws, particularly in California. You're going to be paying for the testing, would be my my advice, as there are labor codes that require it. Similarly, on a federal level too, federal regulations do state that time spent by employees waiting for and receiving medical attention when they're on the premises of the employer or at the direction of the employer during normal working hours does constitute hours worked, so you would have to pay for their hours. Courts and the Department of Labor have interpreted this to include outside work hours as well if testing is necessary for employees to perform their jobs safely and effectively during the pandemic. So again, this is being required because of a grave danger and presumably to the workforce and the community as a whole. So I do think that it would be compensable time. Obviously, a lot of staffing companies that I've spoken to have said, listen, this isn't my mandate. I'm not mandating this. It's not at my direction. It's at the direction of the government, at OSHA's direction. And I think the reply would be, no, you had a choice to either have COVID, a mandate, a mandatory vaccination policy. You chose not to do that. You chose to go the testing route. So that was your choice. And B, it is to protect your employees' workforce and your operations, right? I think you also want to keep in mind too that even if you make your employees pay for the testing, it may impact your FLSA obligations and not allowing them to drop below minimum wage. So for instance, let's say you hired somebody part-time, they work 2 days a week, 16 hours a week, you're paying them $12 an hour, the cost of the test is $100, right? You may fall below the minimum wage of $12 an hour because 12 times 16 is 196. Yeah, so that $100 test just knocked them down. So if you're paying someone around minimum wage, you're going to have to pay for the test. You're going to have to do that math to make sure you don't let that happen. And then finally, like I said, several states do require employers to reimburse for the cost of mandatory testing, such as California, including reimbursement of mileage. So if they have to travel somewhere to get the test, you'll have to reimburse them for that as well.
Yeah, I think it's really important because I've had these conversations with our clients. There's really 3 traps here for staffing firms in terms of compensable issues and compliance issues. There's who pays for the test itself, right? Then if the test is administered outside of the office, right? If you're requiring your internal or contingent workforce to go to an outside testing agency, well, they've got to get there, right?
Mm-hmm.
So who pays for that mileage is another compensable trap. And then they have time, right? They've got the time from they left their house to get in their car, to go to take the test, and then to drive back home in the car. Are they getting paid for that time? So 3 very, very complex issues where staffing firms need to be aware that especially in California, they're probably responsible for all three of those.
Yeah, for sure. I think it was kind of shocking to me that OSHA came out and said that employers don't have to pay for the test. I feel like they were stepping on the Department of Labor's, toes. They were crossing into regulations they shouldn't be regulating. Right? It should have been done in conjunction with the Department of Labor. So I see a challenge there at some point once we get past these constitutional challenges.
Let's shift back and Michael, I'd like to bring you in, but before I do, BJ, there was one question that got submitted right after you finished talking about the state and local tax issues. Viewer 33 asked, how does registration work when a company does not have brick and mortar in a specific state?
Yeah. So just because you don't have assets on the ground in a particular state, if you've got an employee working in that state physically, or as we discussed, if you've got direct hire revenues in a particular state that drags you into that state for compliance, and you cross a threshold under that state's rules for market-based revenues, you need to register with that state's Secretary of State to formally conduct business in that state. And then more often than not, you're registered to file income taxes in that state. If you have a contract worker in that state, you're going to file for unemployment and payroll taxes in that state. So that's really, even though you don't have a building in a particular state, if you've got revenues sourced to another state, that's how you would comply generally.
Thanks, BJ, for answering that question. Well, we still have to talk about a little bit more, BJ. I want to talk about some common tax mistakes that you see staffing firms in, but I want to bring Michael in before wake him up for a few seconds, and let's talk about financial statements because I certainly, again, in the M&A context, see some mistakes that our clients in the industry make on their financial statements. Michael, maybe you can, rattle through some of the top mistakes that you see staffing firms make in their financial statements.
Thank you, Marty, and thank you to CSP for having us. So, we've talked about tax planning, and as part of that, we want to talk about planning for, closing the books, year-end planning on the book side. And so we want to talk about just a few items that pop out when we look at, new client books that could be possible mistakes. And so, I want to be clear, the first two items are relating to accrual basis financial statements, GAAP financial statements. BJ is going to touch upon tax issues when it comes to cash versus accrual, tax returns for books, cash, and for taxes. Cash is obviously basis. When you receive the cash, it's revenue. When you pay the cash, it's expense. Accrual basis is more it's revenue when it's earned, not necessarily when received, and then expenses when it's incurred. So, accrual basis, you have receivables, you have payables. So I just want to make that distinction as the first two items, relate to accrual basis financial statements. So the first item I want to talk about is a cutoff issue on, receivables and then also on payables that we see. Often you will make a payment or you will do billings in the first week of January, maybe even the second week of January, that covers the end of December, the last week of December, last 2 weeks of December. So make sure you are recording that at year end as a receivable, right? So you build after year end, but it covers days before year end, so you'll have unbilled accounts receivable, as they might not be assigned yet, but you have to capture that in the correct year. Same thing on the payable side. You will pay payroll at the first week or second week of January. More common is the payroll accrual. We see more misses on the unbilled AR. So that is, one thing that we notice. Workers' comp liability, especially on the LI side, where workers' comp is a little bit more prevalent. What you want to do is make sure that you are capturing the ultimate liability for open claims at year end. And so everybody has claims, that are open, that are pending. And so you want to make sure that you capture those claims, the liabilities associated with those claims, and you want to make sure that it's the ultimate liability. What I mean by that is that if you have 10 claims for $100,000 at year end, those claims are going to grow. It's just the way it works, right? So those claims for $100,000 by the time all said and done is probably going to be $200,000 that you've paid out. So you want to make sure you're calculating correctly. One way to calculate the liability correctly is you take the number of, in a given plan year, you take the incurred number. So how much in incurred claims did you have, plus the claims that are incurred but not reported yet. So maybe some claims that are going to come through in January and February that might relate to November and December. Add those together. You will multiply by what's called a development factor. You can use historical development factors or growth factors. How do your claims grow, right, for each plan year? And then subtract out what you've already paid for those claims for that plan year. So, for example, let's say you incurred $1 million during the year in claims. After year end, you estimate that there might be another $100,000 that was incurred but not reported. So you got $1.1 million. Multiply it by a development factor, I'm making this up, of 2. So you're at 2.2 million less. Let's say you paid $1 million on those claims already, minus $1 million. Your liability at year end is $1.2 million. And that's for that given plan year. You might have multiple plan years that are still open, and then so you will need to calculate that for each plan year, right? And the further it goes out, the lower the development factor. So obviously, if the development factor is 2 in the current year, year 2, the claims that are over a year old might be 1.2, 1.3, whatever it is historically that you've been seeing, and apply that. And if the claims are really old, maybe you don't use the incurred number, you just use the open reserve number on that. But again, it's important to capture what the ultimate liability is going to be for that, and this becomes much more important if you are stepping up or you're in an audit. Obviously less important, not necessarily less important, but less invasive on the testing side if you're not, don't have audited financial statements. So, and then the last thing I want to touch about is revenue recognition and the concept of principal versus agent. And so this concept is a gap concept where, if you are the principal in a transaction, you are controlling the transaction. You're the person that is the controlling party in the transaction. If you're an agent, you're almost like a middleman. And so, for an example, I will use, for example, Expedia. So you're buying airline tickets from American Airlines. You go through Expedia. You pay Expedia $500. Expedia pays American $450. They keep $50. Expedia records a revenue of $50. They don't record a revenue of $500, right? So in that case, if they recorded $500, they'd be overestimating, their revenue, and so it's important and to make sure that if you're an agent in a revenue stream, we'll talk about what revenue streams companies or agents in staffing. It is important that you record your revenue as net and not gross. And so there's an evaluation process, a multi-step evaluation process to determine whether you are the principal or the agent. So in staffing, in what situations could you be the agent in the process? And it depends on how the contracts are written, but I'll give you a few examples of what we have seen. If you are doing payrolling, or if you are a PEO, meaning you're doing just back office, you are not recruiting, you are not hiring, you're not really in control of the employees, you are just taking somebody else's employees and putting them on your payroll for whatever reason, it is a much lower margin. In that case, you are the agent. So then if you are paying, if you're billing out $100 for that person, you are paying them $90 for that person, you are only recording revenue of $10. You're not recording $100 and an expense of $90. The bottom line is not going to change, but the presentation is going to change. So, if you're strictly a payrolling staffing company and you do, you bill out $100 million, in payroll for payrolling, you're not really $100 million staffing company in that sense. You know, it would just be the net. Same thing with MSP. You know, if you are an MSP, not use an MSP, but you are an MSP, you are in that sense also a kind of middle person between the staffing company and the ultimate customer. So the money is going through you, but you are not recording, you know, gross in that instance, right? And similar with the PEO, like I mentioned, where you know, you would again not have the control in that standpoint. And so one way to kind of spot that would be through you know, what is the margin on the revenue? If it's very low single digit margin, in that case, it's probably you're not, you know, controlling the transaction. You're probably providing some back office administrative functions. And so in that case, again, be cognizant that you're not overstating or grossing up revenue unnecessarily. And it should be shown net. So those three items, just items to keep in mind. You know, again, often we see this crop up for the first time when somebody's stepping up in the type of engagement that they are doing. So if they're stepping up from a comp to an audit or a review to an audit, which becomes much more comprehensive, that is where we're kind of seeing these mistakes pop up.
Thanks, Michael. That's very helpful. And BJ, I'm just going to turn this to you and just ask the same question. When you're looking at so many staffing firms' tax returns, talk to me about some of the common mistakes or common issues that you think they need to be aware of.
Yeah. So, and I want to be cognizant of the time and allow a little time for questions if we need it. So we'll do this a little bit of rapid fire fashion, I guess. But one of the most basic things, if you can remember way back when you filed your first tax return for your organization, you may or may not have known this, but you on that first tax return elected to be taxed either on the cash basis method of accounting for income taxes or the accrual basis method. Mike Zyborowicz just sort of outlined theoretically what that meant, but if you're on the accrual basis, if you elected to be taxed on the accrual basis, you're being taxed on your receivables before you actually collect your cash, which is not typically beneficial, and surprisingly is something I see quite often when I pick up a tax return. For staffing firms, particularly growing staffing firms, the cash basis method is much more advantageous, which means you are only going to be taxed on revenues as you collect them from your customers, as opposed to when you invoice them. Since staffing companies tend to have their receivables run ahead of their payables, it's much more beneficial to be on the cash basis of accounting. The beautiful thing here is that there's a relatively easy fix if you're on the accrual basis method. There's an election that can be made to switch over from the accrual method for income taxes to the cash method for income taxes. And what we see is in the year in which that election is made, there is a very, very large substantial catch-up that allows for a company to reflect a whole lot of essentially losses in the year that that election is made. And I've seen firms staffing firms able to avoid paying income taxes in the year in which that change is made. So if you're filing on the accrual basis method, ask yourself why, and then inquire as to whether you can fix that, and it would very often benefit you. The other main thing when I pick up a tax return that I see, hopefully you're all aware that U.S. the staffing industry is eligible for what we call the Section 199A pass-through deduction, which came about in 2018. Essentially, that lets you exclude from federal taxation approximately 20% of your net income each year under the current tax law. That exclusion is generally applied to your K-1 income. So to the extent you are an S corporation and you're an officer and you're taking too much in compensation in officers' wage compensation, you are shortchanging yourself as far as that tax break. So we very often dig into officers' compensation on an S corporation to see whether you're taking too much or too little because it can have some major, major tax impacts. It extends also to an LLC situation. In the concept of guaranteed payments for member managers works the same way. Are you taking too much in guaranteed payments, which are not eligible for that tax break, versus not enough in flow-through K1 income, which is eligible for that break? Those are really two high-profile issues that we look at when we pick up a tax return. Marty, I'll just throw it back to you because I'm seeing we're running out of time, and I want to allow time for any questions that might exist. So.
And anyone in the audience who has any questions, feel free to start to put them forward. In the interim, BJ, why don't we stick with you for 1 second and talk about employee retention credits, because most people in our industry have explored those and investigated whether or not they're eligible. But why don't you talk a few seconds about the latest that you've seen in that area while we wait to see if there's any questions.
So without, we could do entire seminars on governmental programs for the employee retention tax credit, and which is somewhat aligned with the PPP. I would think that for the listeners, you owe it to yourself to explore whether you may be eligible for the employee retention credit. Essentially, there's a couple of ways into this program. The employee retention credit, if you had a decline in revenues post-COVID as compared to pre-COVID, that is one surefire way to get yourself into the employee retention tax credit program. It's the easiest eligibility test. There are different rules depending on whether you're looking to get into the program for 2020 versus 2021. 2021's rules are a little bit more lenient, so it's often easier to get in there. But don't forget, just because you participated in the PPP program doesn't mean that you can't participate in the employee retention tax credit program. We're talking about really lucrative dollars. If you did not have a revenue decline, there is another way, a grayer test, but another eligibility test that can get you into the program for some meaningful dollars. That other test says that even though you may not have had a revenue decline that is all that substantial, if because of governmental orders related to COVID-19, you had a full or partial being the key word here, partial suspension in operations because of those governmental orders, you can get in even if you didn't have a revenue decline. So what constitutes a temporary partial suspension? Well, perhaps you couldn't recruit because of COVID, you couldn't meet your customers because of social distancing. If you're in light industrial, you had social distancing rules that prohibited you from having a maximum amount of people in a warehouse. These things can constitute a temporary or partial suspension in operations that may enable you to shoehorn your way into this credit. So again, inform yourself, learn about the ERTC, and certainly happy to chat about it. It's much grayer, it's untested, but it warrants your attention, I would say.
Thanks, BJ. And I will add up to that. I think that what is a partial shutdown is incredibly gray. In my personal opinion, I think folks are taking a lot of risk in their expansion of that. With this ERC, there hasn't been a lot of governmental guidance like there was with the PPP loan. So that's allowed for I think given people the courage to be aggressive with it. But I agree with BJ. It is a program that if you qualify can be very lucrative, and I'm sure most of the folks on this call have explored that. But if you haven't, it's probably worthwhile exploring. Well, BJ and Michael and Chris, it's been a pleasure, and Michelle, we thank you so much for having us on again, and we wish everybody a good day, and we look forward to the next time we speak to you.
Oh, well, don't sign off yet, everybody. That sounds like goodbye. Not quite yet. I mean, I know you may have to go, Marty. Thank you so much. But one thing I wanted to just say besides thank you, I mean, we can't thank you enough. Obviously, we ran out of time. There's so much. And everyone's been quiet because there's so much. I've been taking notes like crazy. I'm sure everyone else has too. I'm sure there are many, many questions that won't get answered today just because we have run out of time. The good news for everyone is there's two things I really want to let you know is that both of these firms, Becker Law and Citrin Cooperman, both of them have generously offered that if you have questions after listening to this, whether you listened live or you listened, after live, you've got a copy of it and you're listening now. If you have questions, if you would like to reach out, but you are afraid the clock's going to start ticking and you're going to get a bill, they are generously offering to spend a few minutes with you. Probably not more than a half an hour, somewhere in 5 to 30 minutes to kind of address some questions that you might have. And you might want to actually even kind of do a little mini audit or what have you, or run some things by that are burning questions. But they've both generously offered. Of course, you see everyone's contact here if you are looking at the slides. Your best contact, because like Marty and Chris, they're pretty busy, and I also think, Michael, maybe it's an easier target to get a hold of BJ, maybe. That's the rumor, and then also getting a hold of Mike Bartels is a little bit easier. But they're all there for you. All their contact info is there. You can reach out, and we've had a lot of members that have come back and they have listened to these types of events with Becker, and they've reached out and made connections. And another thing is, I would go through both of their websites. They're loaded with information and all kinds of freebies. And I couldn't believe it when I hadn't looked, to be honest, I had not looked at Citrin Cooperman's website before. You're an industry partner, and I hadn't looked at it until I was preparing for this. And you have all kinds of great stuff on there that is just going to be great for any member. And so we just want to invite everyone to reach out to these gentlemen, to go to their websites, to ask questions and start a conversation. And as far as if you do need legal or accounting, professional accounting advice, they have packages for small and growing companies, so you don't have to be afraid. And we did not shake them down. They generously offered that. So thank you, gentlemen, so much for that. So I'm going to switch the slide real quick. I hate to move away from it. If anyone has questions, but we have so much going on at CSP. Even tonight, we have a mixer in Orange County at the Cerveza Piso Brewery in Santa Ana. It's our first mixer in over a year and a half, I think, in person in Orange County. Join us if you're near. If you're not near, get in your car and drive right now to Santa Ana. And you can make it. You get 5 or so hours. And then we have some other events coming up too. Just before Thanksgiving, if you have issues that you want to put on to our mastermind, and who knows, maybe one of these gentlemen will show up at the mastermind and listen in. Who knows? We don't know. November 18th, we're going to have our open forum. That's from 12 to 1. Just before Thanksgiving. Then we have another open forum just before Christmas scheduled. And we also have Becker is coming back with on the 20th of January at 12 o'clock to talk about M&A issues. Now, they talked on some of those issues today, but they're going to go more in depth. And this was generously offered by Mike and Marty, and we're really grateful for that. It's super. There's other events on our website all the time at CSP, cspnet.org. Like the Inland Empire also has a new legal and legislative update event on the 11th of January. So you want to just look. And then not to forget that we have our upcoming conference that is coming up in June. You want to send all your rookies. You want to send all your seasoned folks. They need to interact with each other and meet our industry partners too. And go to our podcast, our Visionary Thinkers podcast. We've got great podcasts in the can that are ready for you to listen to, and we've got some new ones coming up. So you want to sign up. You want to be part of that because we're in the top 50 in the staffing and recruiting industry. You want to join that. Start following it. And I don't know if you see the fan mail. We got fan mail from Shannon. Thank you, Shannon. And Judy, thank you so much. So I know it's after time, but Mike, Marty, BJ, Michael, we can't thank you enough for coming and being here with us. We look forward to you joining us again. I went back to the slides so everybody can see your contact information one more time. I don't know if you have any other words for us other than, you brought us some bad news, but you also brought us some good news because you guys are the good guys. And the bad news is we have all these rules. The good news is you can help us navigate. And we're really grateful for you.
Thanks so much for having us. Yeah, there's ways to stay out of trouble and to save some money as part of this, even though there's a lot of compliance to worry about. But thank you for having us.
All right. Well, thank you. And, remind everyone, Vital Talks, you want to put this on your calendar because Vital Talks CSP members are visionary thinkers. We're doing today what other people are going to do tomorrow as best practices. And these gentlemen being here today is all part of that. And you can be ahead of the curve. Get your stuff together before they start really opening books and looking at all this stuff. You can do it. Reach out to Becker and Citrin and also CSP if you have any questions. So stay safe and not too safe that you're bored. And we'll see you next time on Vital Talk. Have a great one.
Thank you, Michelle.
Thank you.
Thanks.
Thank you.
Bye all.